Welcome to LevFin Insights podcast series, Levered Lines. I'm Luke Miller, Global Editor-in-Chief at LevFin Insights. I invite you to listen to our series of podcasts where we interview key market participants as we look across the main themes impacting the leveraged finance markets. And with that, over to the teams.
Welcome to LevFin Insights Levered Lines podcast. I'm Steve Miller, a member of the CreditSights team here at Pitch Solutions. Today, I'm joined by loan market legend Lauren Basmadjian to discuss a wide range of topics. Lauren is a partner at Carlyle Group, where she leads the firm's sprawling liquid credit business with $50 billion of assets under management at latest count. Before that, she was a senior portfolio manager at Octagon Credit. Finally, Lauren is a longtime friend of the family here at Pitch. Before we dive in, a quick note to say we're recording this on March 2nd, in the immediate aftermath of the action in Iran, so clearly a lot's in flux. Thank you, Lauren, for joining us in such an interesting time.
Thank you for having me.
Of course. So let's start with the table setter. Can you talk to us about your business at Carlyle and how you aspire to grow it?
Yeah, sure. So as you said, we have about $50 billion of assets under management in liquid credit. Liquid credit is the oldest piece of Carlyle
Right.
credit. So it started in 1999, and the rest of the credit business was built sort of around the liquid business. Today, we are one of the oldest CLO managers. We are the largest piece of Carlyle credit. And we have both the US and European business. We have about $37 billion of assets under management in the US, CLOs under management,
Sure.
about $11 billion in European CLOs. And then we have a business that's $3 billion that invests in other managers' CLOs as well.
Right.
To your growth question, a lot of people do ask, you're so large, you're one of
Yes.
the largest CLO managers. So how do you grow from here? And I'd say, a couple of years ago, this setup was more difficult because we had so many funds that were post reinvestment period and
Sure.
it's sort of in rundown, right? Starting to amortize. So 2.5 years ago, if you looked at our platform, about 40% of our funds or our AUM was post reinvestment period. Today, if you look at our US platform, that's only 5%. So
Wow.
we've spent the last 2.5 years addressing the runoff, resetting, issuing new deals, calling deals
Mm-hmm.
to set the platform up for growth going forward.
Interesting. So entering 2026, everybody who we talked to for sure was very bullish on M&A driven supply, and this was finally going to be the year. How do you scale it now, given all the uncertainty in the air?
Yeah, we were bullish too.
Yeah.
Every time we get bullish, then some event seems to
Yes.
happen.
Yes.
What I'd say is there is an identified pipeline right now. So versus other times over the last couple of years where we said rates are coming down, there's more talk of processes going on in the background. Now we actually have identified deals in our pipeline, and quite large, right? So
Yes.
you have some deals like EA. Paramount Warner, right?
Mhm.
That's added to the pipeline recently. Qualtrics, Sealed Air, right? You could go through a number of transactions. To me, the question is what's behind that,
Yes.
and does that slow now with what's happening in the broader markets, some of the volatility around software, but also the geopolitical uncertainty.
So one question occurs to me as we think about that is there's been a lot of interplay between private credit and syndicated the last few years, back and forth, the paper going. Given what's gone on and some of the headlines around private credit, do you see more of that credit coming into the loan market and creating syndicated loan market and creating supply?
So we had been seeing, I'd say, companies that matured or grew move from private credit, where the cost of debt was just more expensive, right? They were
Sure.
paying higher interest expense, to our market. And we even looked at a deal last week where there was that case where you had a company where a few years ago EBITDA was probably 50 million, now it's 120 million. It makes more sense for it to
Mhm.
be in the BSL market. So I think you're going to continue to see sort of the movement between the two markets. One, on where is the cheaper form of capital?
Yes.
Two, are the banks there or not, right? If the
Yes.
banks are pulling back, if some of these deals end up being hung, you may see underwriting being harder for them. You may see private credit step in again when a
Yes.
time like that happens. So I think they're just more fluid between the two, depending on what the borrower's needs are and what the market is doing.
Interesting. So given that backdrop around the collateral market, what do you think that means for the CLO market? Resets, new issue, that all that this year.
So we were approaching tight since the GFC. Once again, we sort of reached that at the beginning of last year, and we're approaching it again. With some more macro volatility, I do think we'll probably see CLO spreads widen
Mm.
while the market is volatile. But they're still at what I would consider to be historically tight levels.
Yes.
What the problem for CLO equity has been over the last couple of years has been how much spreads have tightened across portfolios, and tightening your liabilities just have not it hasn't kept up with the immense amount of spread compression on your asset side. This volatility should help that, right?
Yes. Yes.
It's not that the spreads on the portfolios all of a sudden balloon out. That doesn't happen. The spreads are fixed. It takes time for new issues to come at wider spreads. But you finally have the opportunity to buy assets at a discount. Today, only 12% of the market's trading over par.
Wow.
The beginning of the year it was over 70%,
Right.
right? Like a huge, huge amount of difference. So it's not just the software names, right?
Mhm.
Depending on the estimates that you look at, maybe software's 12, 13% of the market. And 88% of the market is trading under par today. So you're actually able to put together portfolios of performing credit at a lower price than you've been able to accomplish since really tariffs last April.
Yes.
And I think a lot of us know that when you're able to buy performing loans at a discount in the CLO structure and you get that pull to par on a 10 times levered basis,
Yes.
that's usually a setup for some of the best returns.
Well, that's exciting. Well, I hope it works out that way. So now, obviously, you manage across globally. I'm curious what you're seeing on the other side of the Atlantic.
So if you were to chart our US company results, and we lend to about 575 companies in our portfolio in the US and about a little over 200 in Europe.
Hmm.
And if you were to say what percent of companies are growing revenue, what percent are growing EBITDA, what does that growth look like? They look remarkably similar. You could
Wow.
almost put them on top of each other, and you'll see mid-single digit growth in both sales and EBITDA. 70 to 80% of companies producing free cash flow. You're just seeing a lot of the same statistics from the two markets. The big difference, well, there are a couple of big differences. One, Europe didn't have the immense amount of repricings that the US did. It was just slower, and they kept more of their spread than US did. And two, you don't really have the proliferation of LMEs in Europe.
Mm.
So if you look at the default rates in Europe today, they're much lower than the US.
What? How do you explain that? What's your rationale there?
The rules are different, right? And you have
Mhm.
so many different jurisdictions, and there is a lot more uh, liability for boards of directors, right? And so I think it is harder to do out of court restructurings
Mm.
just because of the setup in many of the European countries. And I do think the market has really tried to push back and say this is not the way it's supposed to be. We are lenders. We're supposed to get
Right.
100 cents back
Right.
before the equity gets anything back. I think they have been more successful, but where you've really seen it come in is cross-border deals, and there
Mhm.
are a decent amount of cross-border deals. So of course, there's some large publicized ones where you've had some out-of-court LME transactions, and I think that's where sort of the Pandora's box has been opened for Europe, where they've been dragged along on some of these U.S. processes, and I think it's only a matter of time until you have European only processes as well. Not that it will get to
Right.
the frenzied pace that we have in the US, but I do think it creeps into the market.
Makes sense. So you mentioned about software. So let me ask you about that topic, which has been obviously very much in focus this year. Um, in your early days, I guess you were a technology analyst, right? And so I'm curious to get your view on what's going on with software, and has it been overdone? Is there opportunities there? What's your thinking?
One, I'm impressed by your research.
I do my best.
Two, that was a totally different sector when I
Fair
covered it.
enough.
If you think about what the tech sector was in the early 2000s, it was semiconductors, right? Or
Mhm.
semiconductor equipment, PCBs. There was no software loans
That's fair.
in our market, and that really didn't start to happen until after the financial crisis, and even more recently than that. So what's funny is if you covered tech back in 2000 to 2007, you actually had hard assets. You were looking
Yeah.
at like the value of your inventory and receivables and your PP&E, and that's mostly left our market, and all the new entrants have been asset-light software companies.
Yeah. I guess that's right. It wasn't that long ago, maybe longer than I think, where people would say with software, there's no assets there. So, right, it's not really a loan product. And just more broadly around the AI disruption trade, what's your thoughts around that? It's obviously affected a bunch of sectors in the index.
Yeah, I think that there is more uncertainty and probably a lot more dispersion of outcomes, and so risk premium should go up for that, right?
Hmm.
I think it's very hard for us to predict who the winners and losers will be.
Fair enough.
We understand that the market is evolving quickly. Um, a lot of our companies have an incumbency advantage at least, but do they keep it with AI native startups or better capitalized investment grade companies who can compete with pouring more R&D behind AI? So um, I do think that it will be uh, the haves and the have-nots eventually, but I think it's extremely hard to predict who the haves and the have-nots are today because, of course, all of our companies management teams are telling us that they're investing behind AI.
Right.
It's only going to be an advantage. Their margins are going to get
Right.
better. They're going to get quicker. They already have an amazing solution. We have not seen it in the numbers yet. If the average price of a software loan today in the BSL market is probably around 90.
Mm.
That's pretty low.
Yeah.
If I segmented all of my industry's performance for the fourth quarter, what industry in my portfolio had the best sales growth and EBITDA growth?
Hmm.
Software.
Of
Still
course.
software,
Of course. Yeah.
right? And you haven't seen the margin compression from the R&D investment. You haven't seen the sales compression from competition. Logically, we know that it's on the come, but we don't know which of our companies is going to be the winners or losers yet. It's going to be data dependent, and I think right now it's just fear selling.
Yeah, that's right. And I guess the fourth quarter results will be coming out. So staying on this AI topic, I'm always fascinated to learn how people in the business are using AI to create automation, efficiencies, interesting processes, that sort of thing.
Yeah, so I'd say that we have a whole team within Carlyle that's focused on AI, and they had an early partnership with OpenAI.
Mm,
They created an LLM model for PE, not for credit, but that was working on helping portfolio companies within our private equity book. Uh, and we've dedicated a lot of resources internally on how do we better analyze our data, right? Let's organize our
yes.
data to make sure that we could put AI on top of it and mine it. So at this point, we're using multiple AI systems, which is
Mm,
interesting, right? Because we're still, I'd say, in beta phase for many of them to figure out where we ultimately go. What it's done so far is it's made information easier to gather and synthesize. It's made us quicker,
mm,
and it's pulled in alternative sources that maybe we would not have found without it. It is not yet writing our deal sheets. It
right.
is not yet modeling for us, but it is making us more informed and quicker.
Interesting. My son, who's 25 and is in finance, called me the other day and said, we were able to do all the stuff through Claude that used to take me hours to do. And now in minutes, I can kind of crank it out. And I imagine you're seeing a lot of that automation as well.
Yes.
Interesting. So switching gears, let's talk a little bit. You touched on it already on the fundamentals of the market. So last year, Fitch Ratings reported a 4.8% default rate. Of that 4.8%, roughly 4 percentage points was in the form of LMEs, LMTs, whatever you want to call them. I wonder how you see the market as you look ahead on that topic.
So when we look at market default data, we look at it a little bit differently. So we look at it by AUM and not issuer count.
Understood. Okay.
But so today, if we look at the market, we see about 2.9% of the
Mm,
AUM of the
okay.
market defaulting, including LMEs. And that has come down from the peak in the fourth quarter of 24, where it was close to 4%.
Wow.
And
Okay.
and so if you think about that, that's actually like a default wave, right? Where did we go in COVID on that same stat? It was 4.5%. So we've been living in this elevated period of defaults really since 2023. In fact, we saw it peaked in the fourth quarter of 24, and we've come down to under 3% today. I don't think that we continue to go down.
Hmm.
So I think we live in this somewhat heightened default environment that was brought on by, some excesses in 2021 alongside of higher rates for longer. But I don't think that we're going into this default wave. I think we're just sort of living in a slightly elevated default environment that's been assisted by the technology of LMEs,
Yes.
right? It's allowed it to be higher because we've had a lot more out of court restructurings for companies that probably wouldn't have filed for a Chapter 11 at that time.
Hmm.
I don't see that stopping.
And when you think about LMEs, how do you tend to approach those? Is it a kind of what I call the clash conversation, like should I stay or should I go? How do you think about that as you look at your portfolio?
Yeah, so when you look at our portfolio, we've tended to lean into the LME situation. Usually, you do have to be big to
Yes.
be in, the steering committee group,
Hmm.
right? You want to the sponsor, the advisors, they just want the smallest amount of people because you're corralling everyone to negotiate with, right? And
Yes.
and I'd say that our size lends to that. Even though we run really diverse portfolios, we have 100 CLOs. Those
Right.
that adds up
Yes.
to usually a large number. So I absolutely understand the should I stay or should I go? I think that's the right call. If you have a small position in one of these LMEs, you could be really disadvantaged.
Hmm.
Um, but generally speaking, we add up to an amount that would make sense for us to see the process through. And we've invested a lot behind sort of the capabilities there. Yes, we have the size. I think that's probably the most important thing. And then do you have the team? And when I joined Carlyle almost 6 years ago, we had
Wow.
2 people that were focused on in and out of court. And today we have 6.
Mm. Yes, as a big team.
Yep.
Yeah, we've got around that. So one last question around this topic, I guess that might be interesting, especially for the folks in our subscriber group that focus on covenant review. Is have you seen changes in the terms and the covenant packages that give people better protections from these LMEs, or is it just kind of keeps rolling the way it's been?
It only goes one way,
It only
and
goes one
that
way.
is down.
Yeah.
No matter what cycle we go through, it could be COVID, it could be, the volatility after Ukraine and rates going up. The credit agreements seem to just only get worse, and there's new. I hate the word technology for it, but new technology being inserted
Yes.
that could hurt lenders.
New and creative approaches. Yeah. So, one question I'd like to ask when I talk to people who've been successful in this business is what advice do you give to young people who either aspire to do more from the seat they're in now or to enter the business, skills they ought to acquire, paths they ought to go down?
Well, right now, I think they definitely have to lean into AI. That's not advice that, I would have given even 2 years ago, but I think being AI fluent, figuring out how that could help you, make you more efficient, help your bosses who
Hmm.
probably don't know how to use it that well, right? Or
Yes.
know all the possibilities. You could become a real asset and resource to an organization by leaning into that. So I think that's like of the moment, and what I would recommend to almost anyone, just as far as advice away from the technology side, I think it's really important to show up in person,
Yes.
to run at things when you have an opportunity. When a door opens, you walk through it,
Hmm.
and try to think creatively. And look, we're in finance, not like we're painting a masterpiece, right? That's not what I mean by creativity. But instead of just saying, I have a problem or I've identified that problem, think about what the solution to that problem is. And that's how you show up every day.
Yeah, that makes a lot of sense, of course. So finally, last question. I took note on your LinkedIn profile that your daughters are working to ease hunger in New York City. I wonder if you give us a post on that and how people who want to be supportive can support them there.
Well, thank you for that. I have 3 daughters, 16, 13, 13
Wow.
years old. And they started a group called Three Sisters. And it was very simple. Last summer, they walked around to restaurants and even meal kit
Mhm.
companies and asked to get their extra food at the end of the day or the end of the week. And then they went to churches and shelters around the Upper West Side, which is where we lived, and said, "We could get you food. Do you want it?" And it's been unbelievable. They're feeding about 400 people a week right now,
Wow.
which is amazing. What I'd say is they need more restaurant partners. It's sad
Mm.
that they have found so many more people and shelters in need than donations of food.
That was very inspiring. Thanks for sharing that. Well, let's leave it there. Thanks, Lauren, for your time and your insights today. And thanks to our listeners for tuning in. Please catch us next time on the LevFin Insights Levered Line podcast.
This podcast should not be copied, distributed, or reproduced in whole or in part. Neither LevFin Insights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. LevFin Insights is not providing investment, legal, accounting, or tax advice. LevFin Insights is not providing research or making any recommendations, nor is LevFin Insights offering or soliciting any transaction with respect to the purchase or sale of any security that the listener may hold.